Greetings, everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely check out the website at cubicleinvesting.com. All right, so I want to briefly discuss something that I always try to convey to my options trading community, that the members of my Flip That Option group, is the importance of selecting which side you place your credit spread, whether it be the call side or the put side. And I always tell them that uh, my preference, right, based upon experience, is to always look to place your credit spread in the direction in which the market is moving after the SPX has made a 20-point move above or below the opening price. So the opening price on May 31st was 52.43. So why is it important for one to place their credit spread or their position in a direction in which the market is moving? Now, of course, assuming you are an option seller, right? Because essentially you mitigate, and so this particular day was the epitome of why I prefer to place my money bag. I'm sorry, not my money bag, but my credit spread in a direction in which the market is moving, is because you avoid the potential reverse in direction, which took place on May 31st. So had you assumed, because of the initial price action of the SPX, that it was safe to go on the call side, your position would have been threatened, and you would have either had to roll your position or close out your position, quickly as possible for a loss, because the market essentially it dropped starting at around 935, 940, and it dropped continuously until mid-afternoon, and it essentially did a 180 degree, really 360, right? Really 360 bounce, and it actually, went above the opening price on this particular day, this particular trading session, May 31st. And so had you been on the call side, your position would have been threatened, and so you would have had to close out your position or either roll the position. And I'm not a big proponent of rolling, but I do roll positions from time to time. But nonetheless, considering the strategy that I use, my trading style is to actually trade in the direction in which the market is moving. So I actually placed my credit spread position at 1239. I got filled, and I was at my level 3 on the call side, because I come up with levels of interest, what I call levels of interest, every day. I come up with 3 LOIs on each side. So on the call side, the LOIs were 5270, 5290, and 5305. And on the put side, you see the levels of interest here. And so based upon experience, I know that the SPX rarely closes the trading session beyond level 3. So I like to get to my level 3, assuming that I can get a good credit, $25 or more, sometimes $20. So I can get to level 3 because it's a high probability position to be in. But it also, when you are trading in the direction in which the market is moving, you avoid the potential reverse in direction, like we saw on May 31st. And actually, which is rather unusual, the market actually dropped 20 points below the opening price to 52.23. It went below, and it also rose 20 points above the opening price, which was 52.63. In the same trading session. That's rather unusual for the SPX to move in that manner. But on this particular day, That's what occurred. And so, my position was never threatened on this particular day. As a matter of fact, my entry into the trade was really great because when I got into the trade, it was pretty much at the floor where the SPX had actually developed a floor for this what's 12 around 1230 1235. SPX really developed the floor and it never actually pulled back. It just kept going up, trending to the upside. And so so it was pretty much easy trading session. And so this is one of the keys, in my opinion, to trading the SPX 0 DTE effectively, and that's trading in the direction in which the market is moving. Now, of course, I always wait until the 20-point move has been made. So that's my cue to put on a trade. And then I use my levels of interest as a reference to place my my credit spread. So hopefully this helps you guys out.